cost of interest rates are going to rise globally, and that is going to have a positive impact on inflation. What are the similarities and differences between markets at this moment in time and where they were in July of 2019, exactly 3 years ago? There are some significant differences. Oil is twice as expensive. The spread on high yield bonds is materially higher. Unemployment is the same, but inflation is 7% more than it was then. And we expect materially higher changes to the Fed policy rate, including quantitative tightening. So we're at an interesting time because at that point in July of 2019, things were in stasis. And now, even though valuations are very similar, markets are moving far more progressively forward in a way that we actually have to analyze and assess. These differences explain why we've taken a defensive posture, but remained fully invested in our portfolios. We've taken some major steps in reorienting our portfolios to making them more conservative, to making them more resilient, while exposing ourselves to slightly more positive outcomes potentially over the next 12 months in China. All of that is a conservative point of view because of the fact that the data are inconclusive as to whether we are definitively going to have a minor recession in the United States or not. The real drag on income growth is associated with our temporary and high level of inflation. The other thing that's going on, obviously, is Fed tightening. We know that a decelerating economy and Fed tightening actually don't normally go together. The Fed usually raises rates when things are overheating. So with U.S. corporate grade securities at their highest interest rate level, right, since 2010, and with the maximum amount of medium duration Treasury yield expectations being priced into the market, we once again are expecting that inflation will actually come down, even as the Federal Reserve is going to be emboldened to consider tightening as we move ahead. Now, Europe has some risks that we don't have here in the United States. They have higher levels of price pressures directly related to energy, right? Because their dependence on Russian energy is significant. And they also have much more supply disruption because of the nature of the geopolitical risks taking place as a result of the war in the Ukraine. So what we see happening now as we look around the world, both in the US and in Europe, is really central banks that are embarking on a short but sharp tightening path. And all of this suggests that interest rates will be much higher by year end, even in the euro area, which is an area that has had much lower rates than we have. The bottom line is that the cost of doing business, the cost of interest rates are going to rise globally. And that is going to have a positive impact on inflation globally over time by slowing the overall economy. The fact that we still have positive growth, given all of the news and given all of the interest rate increases across central banks, is itself heartening, but it may not be sufficient to keep us from falling into a minor recession. And we'll know all of that over the course of the next 2 to 3 months. And why that matters is that that's why we have changed our portfolio structure to be more conservative, to leave us be in the right places and assuming that things get a little softer, but not taking us out of the market, which could actually cause us to potentially miss a sharper rebound in 2023.